So today on the show, we're going to talk about understanding equity. So we'll just cover some terms, different types of equity that you should be aware of if you're a real estate investor or just getting into real estate. So the first term you hear is built-in equity. That's found, kind of in that value add space. In a market like we have today, for sure, in somewhere like Alberta, you're not buying a lot of distressed property or a lot of properties that are way undervalued. In a market where, there's not a lot of buyers, that's where you're going to find these deals. So built-in equity basically means you're buying a property for less than it's worth. So you're buying a property for $1.7 million and it should be worth $2 million, but the owner has to sell. Maybe they're in trouble or there's something wrong with the property. That's a lot harder to do in today's market. Even the value add deals that are out there are trading really high. They're kind of building in some of that future equity. But in a soft market, in a downturn or a market that's not hot or people don't want to be in, that's where you can buy those. I've seen in the States a couple bigger syndicators kind of selling built-in equity or saying they're buying stuff below replacement cost. Unless you're buying a brand new property below replacement cost, that doesn't really exist. If you're buying an older property, it's obviously going to be well below replacement cost. That's one of the benefits of buying it, but I wouldn't call that built-in equity. So basically, built-in equity is if you can buy it, the day you take over, it's worth more than you bought it for, you have that built-in equity. So forced equity or forced appreciation, this is kind of the fix and flip or the BRRRR method, where you come in, you buy a piece of property, usually you're going to use some kind of temporary debt, you're buying it, and then you're forcing appreciation. So you're going to go in, do a bunch of renovations, get the rents up. And at the end of that year or 18 months or however long it takes you, you're going to force the appreciation of the building up. So maybe you got rents up a couple $100 and you've been able to, now there's a lot more equity in the property than when you purchased it. So maybe you bought it for $1 million, went and put $200,000 in, now it's worth 2.5, you have $300,000 of built-in equity. Multifamily works really well doing this program just because you're valuing everything at a cap rate. So any $1 of extra income adds $20 of value to the property. So with forced equity, you have to have some insight into the industry and kind of understand, where rents can go in that property. If you're buying a property that has $1,500 rents and the market rent is $1,500, it doesn't really matter what you do. You're not going to be able to go in there and get rents to $2,000 because there's just not room there. This works where, rents are well below market and you would know, if we go in and do renovations or maybe it's been mismanaged and we can go in, get a bunch of the tenants out, get their rents up to market or maybe slightly above, that's where you can force that. So it's going to take a lot more work and you kind of have to understand what you're doing. I wouldn't recommend it for a first-time person, but I know lots of people, this is kind of their model. They go in, buy stuff with temporary debt, refinance it out in a year or two at a much higher value, and they have all that built-in equity. Usually you can do that model and have no money left in the deal of your own. You just have the equity that you built, forcing that appreciation. So the next term would be market-driven equity. It's appreciation, essentially. This works really well. This is kind of our model. So we go in, when we buy something, we put long-term debt on. We do a little bit of the forced appreciation where we renovate units on turnover, but we're not trying to get all the money out right away. We're kind of letting the market do its thing. So over enough time, rents will generally always outpace inflation. So you're going to get some upside over a long enough period of time. And when you leverage a property, that makes quite a big difference. So that's our model, is we're 10-year buy and hold. So we'll buy a property, we want to hold it for 10 years. We know that over that period of time, rents are going to climb, a couple percent a year. There's going to be down years and up years, but they'll average a few percent a year. So it makes a big difference. That's in Alberta in the last couple of years, we've seen rents go up 15%. So that's been a huge increase in market appreciation of the building. Even if you didn't do any renovations, you kept the same tenants and you just got that 15 to 20% rent bump, your expenses have remained pretty flat. You've got that building's worth a lot more than so if your model's long-term buy and hold and market appreciation is what you're looking for, you want somewhere where there's immigration going to that place. There's not going to be a whole bunch of supply coming online, and you have good jobs, right? You want people to be employed. So that's why we really like Alberta. There's been a lot of people moving here. There's well-paying jobs. And it just, in Canada, you can't build fast enough to meet demand. So we know that there's not going to be a huge oversupply coming on. There's some places like in Texas or there's some of the bigger cities in the States where there's a huge amount of supply that's coming online right now. And it's really kind of sucking up the rents aren't going up in those markets because there's not enough people to fill the units. So those are the couple things you want to just look. It's basically supply and demand is going to cause rents to go up over time. That's what you want to look for. Good jobs, good migration going to a market. So sweat equity is something you'll hear usually when people are raising capital. If you ask, what are you putting into the deal, they're going to say sweat equity. And that essentially just means, if you don't have the money to put in, you're going to spend your time doing it. So whether that's you putting the deal together, raising the capital, and then using the fees that you would get paid just to roll into the deal, or it could be physically going and renovate. People on flips will do this all the time. They'll be putting in sweat equity by physically going in and doing the renovations themselves, finding the deal, doing all of that. It's a good way if you don't have any money to get into a deal. Maybe you partner with someone 50-50. They bring the money, you put in all the sweat equity. You do want to make sure, I think a lot of times for sure on smaller flips, people don't actually calculate the amount of time they put in. So, maybe they make 10 grand on a flip and they spent hundreds of hours on it. So you want to make sure that you are keeping track of that and that your time is being best spent doing that and not just working at your job overtime and making extra money. I've always been a believer. I mean, we are always we're the biggest investor in our fund. We put money into every deal. I do think that there should be some skin in the game, right? Because if all I have to lose is sweat equity and you have all your money to lose, that's not really a fair trade. In my opinion, there can be some sweat equity, but you should also, be investing with someone who has some skin in the game. So the next term we're going to cover is leveraged equity. There's different, ways to use this. I've seen people who've a home mortgage, they have a house that's mostly paid for. They'll take that equity and go buy a rental property. It goes both ways where it's slightly more risky because now you have leverage in two places, but it can also be a lot more rewarding. Or if, a lot of people starting out, you might have the money to buy the first property. Maybe you do that value add model and now you can pull money out of the first one and put it in the second one. Technically you leveraged that first property and you took that equity and bought the second one, but it can really compound your gains if everything works well. Because if you put, if you had $100,000 that you could take out of the first property and put in the second one, if the second property, goes up in value and you're making money on that money and you're making money on the first deal, that's where leveraged equity can really, really grow. And it's in something like a buy and hold, like a 10-year hold period. If you can refinance that money out at year 5 and use it to buy a second property and they both go up with just market appreciation, I think you're a lot better off than leaving that money in the first property for the whole 10 years, because now you have two properties that are leveraged that are going up in value. Obviously, there's more risk than just having that money sit in the one property because you have two mortgages. If things go bad, they could go bad, double as bad. But I think over time, it's a good strategy with real estate. It's one of the, the asset classes where you can pull equity back out, invest it into another property, and really grow your portfolio that way. For sure, if you're looking at it over a 20-year period, the amount of money that you can recycle out of a property, you can refinance the same property multiple times over that time period and buy new pieces of property with it. For sure, if you're getting good appreciation. So leverage equity can be great. It really is one of the things that can grow a real estate portfolio, because instead of, bringing in new investors or having to come up with more capital, you can just use the existing capital that's sitting there kind of dead in the property anyways and put it into a new property. So leverage equity, I think it's used both for individuals and for funds, right? It's if you're an individual and you're trying to do this all on your own, you're going to run out of capital at some point and need equity from somewhere. If you can pull it out of an existing property and put it into a new one, that works really well. For a fund, like we've done this in the past, where instead of having the money sit there, in a property for another 6 to 8 years, we can pull it out, buy a new property. We didn't have to raise a bunch of capital to do that. So it can work for funds or individuals. I think it's, this is kind of a huge part of real estate. If you're going to grow and keep scaling, the risk with leverage equity is that you're leveraging up higher, right? So if the plan was that in 10 years, you were going to pay down the mortgage and you were going to pull all that equity out. Now, if you've pulled a bunch of that equity out and maybe things changed, maybe rents went down slightly, interest rates went way up. Now you might be in a position where you've actually over leveraged that property and you don't have the ability to pull equity out, or maybe you have to even put more money in to renew that loan. So that's where the risk can be. If the market turns and you've over leveraged the property, that can be a big downside. And in in the market in Canada right now, when everybody's using 95%, a lot of stuff is very leveraged already, right? When I started, you could only go to 85%. People would still take 75% loan to value. So there was a lot of equity there, and it would make sense to pull out 10% here or to do it. When you're at 95% already, it can still make sense to do it, but you got to make sure you're not over leveraging that property. And if interest rates all of a sudden go up 2%, you can still get a loan when that term is up. The last term we're going to cover is preferred equity. That essentially, in a syndication or somewhere where someone's raising capital, that essentially means that equity is getting paid first. So maybe there's a set return of 5% or 8%, and that's getting paid out usually before any fees or any of the common shareholders will get paid out. So preferred equity, that just essentially means you're going to have a preferred return, or there's going to be some kind of benefit there. You're going to get your money out first before the other people do. So maybe you're the one bringing the money. The people putting the deal together are going to hold common shares or common equity, and they're getting paid last. So there'll be more upside for them. They're probably taking a split of the preferred equity, but the preferred is going to get paid out first. So a lot of times in a syndication, that's what they're looking for. It's preferred equity, or there's a set return, or at least a hurdle rate where they're going to get 5% or 8% before any fees are charged. So that's usually what, as an investor, you can look for that for preferred equity or what type of equity you're buying. So usually the preferred return is the least risky way because you're getting money out first. But yeah, and there's so many different ways to structure deals like this. So a lot of them, that means a preferred return, but it can be done a bunch of different ways. So we just went through a bunch of different types of equity, what they mean, how they're used in real estate. For me, I think, the best one, the one that we would use is kind of market-driven equity. So we're buying a property, letting the market appreciate that building over time. It's safe. To me, there's a lot less risk. I think the most risky one, there's obviously high risk, high reward, would be the forced equity one. And the only reason there's more risk is things can go wrong. You can time it slightly wrong. Building might need a bunch more work than you were expecting, but there can be a lot of reward there at the end if you can do it correctly. So thanks for listening to this episode. We'll see you guys next week.